am a specialist in looking at the risks to the markets and the portfolio that we cannot quantify, politics, policy, geopolitics in particular. And I spent a lot of my time with policymakers and some of the world's biggest investors, trying to hear where the gaps are in the understanding of what's likely to happen, because perception gaps, when they close, they create price movements, and my job is to try to identify where those are going to happen. Emerging markets are very interesting because on the one hand, everybody wants to be invested in them because that's where the growth is, especially against the backdrop of deflation in the West. On the other hand, we're seeing something very powerful happen, which is inflation is starting to rip through the emerging markets, and very, very fast. And it's happening through the worst possible channel, which is food prices. We've just seen the first food riots of this cycle. They happened in Mozambique. Now, most people say, what do I care about Mozambique? That's a long way. But the bottom line is inflation always hits the most vulnerable, marginal location first. So it's a bit of a symptom of something we're going to continue to see in other parts of the emerging markets, and therefore we should be paying attention and asking ourselves which emerging markets will be able to effectively address this pressure and which ones will not, and maybe beginning to separate in the portfolio one's exposure. Also, taking into consideration, how do you think the workers are going to react when half of what they spend is on food and those food prices are going up so substantially? We had a very interesting event happen about 2 months ago where the Bangladeshi textile workers went on strike for 3 days. They got a doubling of the minimum wage. The government delivered that, and then they probably rioted for a further 3 days. And why? Because if you double my minimum wage, but my food price is going up over more than 100%, I'm behind. Most central banks are very nervous about deflation. So how can I argue inflation is a risk? Well, partly because we're seeing it start to jump in very specific things. So for example, Levi Strauss announced that in reaction to the record high price for cotton, which is a function of banks are not lending to farmers, so farmers are not planting, in conjunction with the Bangladeshi textile worker settlement, the price of blue jeans is going to go up. Lord Wolfson here in the UK, who's the chairman of Next, has repeatedly been talking about they're going to have to pass on an 8% higher cost of goods to their customers in this coming year. That will be the first set of price hikes in textiles since about 1985-86. After years of declining prices, we get an 8% jump in one announcement. This is big. The way to watch for inflation, in my opinion, is not the data point. Don't watch the CPI. That's not going to help you very much. The thing you want to watch for is literally the size of candy bars. They get smaller. It's already started. Walmart recently reduced the size of its sort of core coffee can from 39 ounces to 33 ounces. It used to specify where the coffee came from. Now it says premium. This is a way of charging you the same amount of money for less and a lower quality product. That's inflation. And so that's why I think this emerging market inflation pressure is important for us to keep an eye on in the West. And it has huge implications for all of our portfolios, for the performance of equities, for the performance of bonds. Makes me really interested in owning brands, strong brands that can pass on those higher input costs. And it makes me think through what my assumptions are about the future in a way that I might not if I weren't paying attention to that set of pressures. This food inflation begins to create geopolitical risks, as in country risk. And we will see some governments destabilized as the population is hit by much higher food prices. Different countries will be in different positions to be able to handle that pressure. So that's one form of geopolitics that I think we ought to keep an eye out for. Another form is that as the price of energy, raw materials, and food goes up, governments now have a much stronger interest in controlling, owning those assets. So we're going to see countries contesting for ownership of these assets more and more. This is one of the things we're witnessing in Asia at the moment, where the Chinese are claiming the open ocean territory that's above the gas fields as pretty much their own. Other countries say, excuse me, that's disputed territory, and I think it really belongs to me. So they are reaching harder than they were for those assets. And that leads to disputes. That leads to the US and China at times being quite nose to nose in a kind of a military chicken that's going on. It's not something I expect to escalate, but it creates an environment in which accidents can happen. And that's why I say geopolitical risk now needs to be an important element of our thought process, particularly about emerging markets. Well, I think we're going to have sovereign defaults. I don't think it's avoidable. And that's been my view since the beginning of this financial crisis. I think it's clear what we did is we took the losses that were in the banking system and we moved them off the bank balance sheets and onto the government's balance sheet. But this doesn't diminish the loss. It still has to be paid for. What's happening is people are beginning to understand that the first round of austerity, which we're experiencing here in the UK, that the Irish engaged in some months back, is only round one. And eventually, it becomes clear to the political leadership that the cost of defaulting is lower than the cost of paying. And so therefore, my bottom line is not only will we get default, but we should buy when the default is announced. Most people will do the opposite. They will see defaults and they'll get scared and they'll want to sell everything in the portfolio. My view is once you default, it's like hitting the reset button on your computer. It clears the decks, you start again, and now you can grow. In this current crisis moment, we've seen as the bond spreads blew out for Greece, for Ireland, for Spain, that the bank share prices did not fall commensurately with that. And that's because of that fund the Europeans created, which was supposedly designed to bail out Greece, but in fact, what it's really designed for is to protect the banking system if Greece defaults. And what we now know is that firewall is working. And that raises interesting questions for investors, like maybe companies are a better bet than countries. The new risk-free rate of return maybe isn't a government. That's something to really think about. Well, I think 2011 is going to be a really interesting year. I think volatility is suppressed by all this quantitative easing. The governments have thrown so much cash that it just pushes volatility down. But given all the pressures that we face in the world economy, the risk of inflation versus deflation, the high probability that we get sovereign defaults, by the way, that includes municipal defaults in the United States, which I think is very likely to occur. Now you've got food inflation pressures, which leads to political instability, civil unrest issues in emerging markets, starts to deteriorate the margins, of the productivity for emerging markets. All these things tell me volatility ought to be higher. And so I'm anticipating that that's going to happen. That will affect many asset classes. We'll see this particularly in commodities, because not only are people buying commodities on an inflation view or on the view that there's not enough supply, both of which I tend to agree with, but in addition, these are the only prices that are rising, right? So everybody wants to be involved in them. So the minute you take liquidity out, like the Chinese say, we're going to raise interest rates for the second time, everybody chokes and they start selling. The second thing is, I think brands are very, very powerful in this new environment. You want to own brands that have the capacity to pass on higher costs, because I think higher costs are now inevitable. The environment we're in, I think, has two exit doors. One exit door is what you might call the renegotiation of the social contract. That's where the state is defaulting on the citizens, or the state says, we're just not going to pay for stuff that you thought we were going to pay for. And now you've got to pay for it. And some countries will manage that process smoothly. Others will get some civil unrest around it. It's going to be complicated, but that's one way you fix this whole picture. The other exit door is innovation. And I'm a big buyer of innovation. I think these pressures that I'm describing are so severe, and they will compel businesses to be more creative, more innovative, use their ingenuity in getting back to the bottom line of positive, unimpaired genuine cash flows. And as investors, that's what we should be focused on, the genuine unimpaired cash flows that exist out there. And they exist everywhere, which is why when I'm asked on a question like this, which people are often really aiming at, is should I be in or out of China, or in and out of the UK, in or out of equities, in or out of bonds? I still think you want to be in genuine cash flows, and you want to be out of anything that is strictly driven by speculation. So that requires some discernment and a good deal of skill to manage that set of pressures. So I'm very optimistic. I think there'll be great investment opportunities that come out of this, but it's a trickier, more complex environment than we've had for a while.